Can I deduct my traditional IRA contributions? Imagine saving for your future and paying less in taxes today. That's what a traditional individual retirement account can do for you. But the question is, can you actually deduct those contributions from your taxes? Let's break down the facts so you know exactly how it works. A traditional IRA is a special account that helps you save for retirement while offering tax benefits. When you put money into it, you might be able to subtract that amount from your taxable income for the year you make the contribution. This can lower your current tax bill and help your savings grow without taxes until you withdraw the money in retirement. Almost anyone with earned income can contribute to a traditional IRA, no matter how much money they make. There are no income limits for contributing, but whether you can deduct those contributions depends on some other factors. The main things that affect your ability to deduct are if you or your spouse are covered by a retirement plan at work, your filing status, and your modified adjusted gross income. Your modified adjusted gross income is your total income minus some deductions, with certain amounts added back. If neither you nor your spouse has a retirement plan at work, you can deduct your full traditional IRA contribution, regardless of your income. This is a simple rule that applies to many self-employed people or those whose employers do not offer a retirement plan. But if you or your spouse are covered by a workplace plan, the IRS limits how much of your contribution you can deduct based on your income and filing status. For example, in the year 2025, if you are single or head of household and your modified adjusted gross income is less than or equal to $79,000, you can deduct the full contribution. If your income is between $79,000 and $89,000, your deduction is reduced. At $89,000 or more, you cannot deduct your contribution. For married couples filing jointly, if your combined income is less than or equal to $126,000, you can deduct everything. Between $126,000 and $146,000, the deduction is partial. At $146,000 or more, no deduction is allowed. If your spouse is covered by a workplace plan but you are not, the limits are different. For married couples filing jointly, if your combined income is less than or equal to $236,000, you can deduct all your contributions. Between $236,000 and $246,000, the deduction is partial. Above $246,000, you cannot deduct. For married filing separately, if your modified adjusted gross income is less than $10,000, you can take a partial deduction. If it is $10,000 or more, no deduction is available. These income limits are updated each year, so it's good to check the latest figures. Many Asian American families have diverse financial situations. If you run a small business without a retirement plan, you can likely deduct your full IRA contribution. If you work for a company with a 401(k) plan, pay attention to your income to see how much of your contribution you can deduct. Even if you cannot deduct your contribution because your income is too high, putting money into a traditional IRA still helps your savings grow tax-deferred, which is a big plus for your retirement planning. If your income is above the limits for deduction, you can still contribute to a traditional IRA. The money will grow without taxes until you withdraw it in retirement. When you do take money out, you will pay taxes on the earnings and any deductible contributions, but the non-deductible contributions are tax-free since you already paid taxes on them. To claim your deduction, you report it on your Form 1400-0. It is an above-the-line deduction, which means you don't need to itemize your deductions to take advantage of it. Just include the amount on your tax return, and you're good to go. In the end, deducting your traditional IRA contributions can be a smart move to lower your current taxes and boost your retirement savings. Your specific situation, especially whether you or your spouse have a workplace retirement plan, and your income level, determines how much you can deduct. Remember to review your circumstances each year because tax laws and income limits can change. If you're unsure, talking to a tax professional familiar with Asian American financial situations can help you make the best choices for your family's future.